So what we're going to look at today is interest rates and investment demand. Okay. So more on interest rates. So to begin, we have to look at like what is an investment. Okay. So when we look at investments, we're typically looking at like what businesses, what are they investing in? So it's money that's spent on expenditures, basically for a business. They could be looking at new factories. Companies want to open up additional factories to produce more products. It could be capital. Remember going all the way back to the beginning when we looked at capital as far as equipment needed. That could be machinery. It could be also technology. All those things are needed by businesses in order to grow their business, expand their production, increasing overall GDP as these investments take place. Okay, it could be new homes. Again, that goes towards construction, counting towards GDP, or increasing their inventories. Okay, so it's basically when businesses are spending money in order to further their production. Okay, so that's the kind of investment we're looking at right now. Okay, so expected rate of return. So how does a business make this decision? Well, what they're going to look at is what they call they're looking at cost benefit analysis. So they're looking at how much is this investment going to cost me or cost my business versus how much is it going to benefit me in return. So think all the way back to when we looked at like opportunity costs and decision making. Businesses are doing this on a much larger scale. They're looking at if I invest, $1 million into my business, how much is that going to benefit me in the future? Like, is it going to be worth it? All right. So when they're looking at is it going to be worth it, they're looking at that expected rate of return. Okay. How much am I going to get back from this investment based on how much it's going to cost me to actually get this money and make this investment happen? Okay. Well, the cost of this investment is going to be the interest. Okay. When they're taking out loans, when they're wanting to build new factories or they're wanting to add more equipment, things of that nature, they're looking at how much is this going to cost. Okay. So when they're determining it, what they're looking at is the expected rate of return to how much it's going to actually cost them in interest. All right. So if the return is going to be greater than their cost, then they're going to invest. Okay. Again, because we have opportunity costs. So uh, they have to make tough decisions and they only have so many resources because of scarcity. They have to decide, is this going to be worth it? They can't just decide I'm always going to invest and grow or I'm never going to invest and grow. Sometimes it's going to be worth it for them to invest and sometimes it's not. So, if that expected rate of return is going to be less than the interest cost, then they're not going to invest. So, again, they're looking at, is this going to be profitable? Is this going to help my business grow? And if so, is it going to be worth how much it's going to cost me to make this initial investment? So, what they're looking at is the real interest rate. Okay. So, real interest rate versus nominal. Okay. Nominal interest rate is what we see. Okay. That's happening at current prices. Um, the real interest rate is going to be what we see without inflation. Okay. So looking back on it, what is it actually going to cost? Okay. So to figure this out, we simply look at the real interest rate. We take what the nominal interest rate is and subtract inflation. We did that in the last unit. Okay. So what determines the cost of the investment is the actual interest rate, okay, the real interest rate. So minus all the inflation, taking the inflation out, okay, what is it really going to cost them in the long run? Okay, we're looking at real interest rate. So with this, we get the investment demand curve. All right, this is going to be similar to other demand curves. It's going to be a downward sloping curve. Okay, why is it downward sloping? Okay, so when interest rates are high, okay, fewer investments are going to be profitable. Okay, when interest rates are low, more investments are going to actually make money because you're looking at
how much is this investment going to cost them versus how much are they going to get in return. Okay, so we're looking at that yield, the rate of return, like how much are they yielding back on this investment. Okay, few investments are going to give you a huge rate of return. Okay, many are going to be low rates of return, so that interest rate really affects how much they're willing to invest. If they know that most of these investments are only going to give them like a minor or a low rate of return, it's still going to be profitable. But as they're looking at that interest rate, is it going to be profitable enough to counter the cost of that initial investment? Okay, that's more of what they're looking at. So interest rates are high, investments tend to be not as profitable. When interest rates are low, they can be more profitable. So that interest rate is really important for a business when they're looking at, is this investment worth it or is it not worth it? Okay. So here is your normal investment demand curve. So we see it's downward sloping. We have our real interest rate. Okay. Over here, down here on the bottom, you have your gross private investment. I remember that factors into GDP. Okay. Again, so as that interest rate is high, that gross private investment is going to be lower. Okay. Less private investment is going to take place because, again, most of these investments are going to yield a lower rate of return. All right. So they want that interest rate as low as possible, okay, closer down here to actually invest that money. Okay. So when this happens, when this interest rate changes, it can cause that demand curve to shift left or right. All right. So here's just an example. All right. So you see at 5% interest. Okay. This is just an example. This isn't how the graph normally looks. Normally, you're just going to see this. Okay. But this is just showing you that at 5%, if that would be the interest rate, okay, we might only see $2 trillion invested. Okay. But if we drop that interest rate down to, let's say, 3%, you're going to see upwards of potentially $3 trillion of investment. Again, these are just example numbers, not like that's exactly what it's going to be. Okay. But as that interest rate drops, more and more companies are going to be willing to invest that money, that gross private investment, because it's going to allow that expected rate of return to grow. Okay. And it's going to give a better chance of actually making money off this investment. All right. So the things that can cause investment demand to shift. All right. So cost of production. This one's real simple. How much does it cost them to produce these goods and services? All right. The lower the cost, that will help offset or help alleviate potentially a higher interest rate if they can lower the cost. So if their cost is lower, they're going to want to increase their investment demand. That gives them a better gap there, or a smaller gap that they don't have to make up as much to maybe counter a little bit of a higher interest rate. Okay, business taxes. Business taxes can lead into higher cost of production. This kind of goes back to when we were looking at supply and short run aggregate supply. When business taxes are inflicted on companies, that tends to increase their cost of production. So that's cutting into what they can earn. So they're not necessarily going to be willing to increase their investment demand if they're going to have to pay higher business taxes on the back end. That's going to lower their expected rate of return. It's going to push them away from investing. Technology, new technology, they're going to invest in that. It can maybe increase their production, make their business more profitable. Capital. So think of capital, think of the tools and things needed in order to produce. So when you see an economy that's low on capital, okay, they're going to want to increase that investment demand. They're going to want to build up the capital, that those machines, the technology, more storage spaces, factories, anything like that, in order to boost their profits. Okay. When we have a lot of capital, they really don't have a need to invest. So you're going to see investment demand decrease. Okay. And then with anything with the economy, a lot of it depends on expectations and what's going to happen in the future. Okay, positive, negative expectations. Think back to what we've been through these past 7-10 months, whatever it might be for COVID. A lot of negative expectations on, is the economy going to recover? When's it going to recover? During that time, didn't see a whole lot of investment taking place. Okay. To counter that, what you saw was the Federal Reserve lowering the overall interest rates in order to kind of keep that rate as low as possible, to push these businesses to continue to invest, to try and keep the economy going. You see that lower interest rate, again, that helps them get a higher expected rate of return. So with that taking place, they're going to want to see, or they're going to see potentially more investment demand. Okay. Now, with the breaking news that there could be a potential vaccine in the future, or that's effective, that could start being rolled out later this month to individuals, and then to the masses early next year into the middle of next year, that could be something that's a positive shift that pushes that investment demand to the right to increase it, because those expectations have now changed. Okay. Here's your changes. Okay. Again, overall change. Notice the interest rate hasn't changed, but could be something positive like the new vaccine. Could increase the amount of investment demand to the right. Okay, simply because something has changed in the market, causing a potential for greater investment. All right, interest rate stayed the same. Interest rates are going to remain relatively low right now, so the interest rate doesn't really change how much people are willing to invest. But because of this potential vaccine, it's going to increase how much people would be willing to invest. Okay, so now with any investment, there's always going to be instability. There's going to be several factors that go into. People aren't just going to always invest, and it's not ever going to be where they're never invest. It just depends on the timing. Okay, so durability. All right, once people purchase capital, that stuff tends to last, several years at a time potentially. It's not something that they're going to have to invest in every single month or every single year. So that could see, a decrease in investment simply because they don't need to buy it. They don't need to buy new machines for their factory every single year or once a month or something like that. Another thing you see is the irregularity of innovation. So as we move through, year in and year out, innovation doesn't happen in just a straight linear fashion where it's going to always see increases in innovation. Okay, tends to see little small like explosions of innovation, and then nothing really changes for a while. Okay, so think about smartphones. As smartphones came about, you had the new iPhone, everything. All of a sudden, there was just this mass, influx of innovation in phones. And if we look at phones over the last, 5 years, they're relatively the same. Now, I know they changed little things here and there, better cameras, but the overall design has not really changed. Okay. Now, here in the future, could there be something different? Of course, but it doesn't just automatically happen to where every year there's something new coming out that's just game changer. Okay. Profits. Okay. As things change, competition, what people like, obviously we're humans, we can make mistakes. So things happened where things aren't profitable. We go through cycles in our economy. Again, the economy doesn't always go up and it doesn't always go down. It's kind of an up and down roller coaster of emotions, if you will. So profits are not always going to be there. If you're not always going to be the only company that's producing something. Okay, there's always going to be challenges that you face, and then again, expectations. Okay, what's happening? Political, social, natural phenomenons, things that change our expectations. Okay, you're seeing that right now. We're potentially on the verge of a presidential switch, depending on what happens with the litigation of the election. We might have a new president come January. You're seeing changes in the market. You're seeing certain companies
increasing production. You're seeing certain companies decrease production. You're looking at just here recently with this new vaccine that has come out. If you've paid attention to the stock market at all, lots of the at-home companies, your Netflix, your Zoom, Amazon, all these companies that people were just exploding due to people staying at home and quarantining. All of a sudden, people are looking at those and saying, well, we might not need those as much anymore. Okay, so all these things can change. Just know that investment's not always going to be something that's linear, that's just always increasing or always decreasing. It's going to go with the flow of the economy. Okay, so going back to the business cycle, okay, most people believe that the investment instability is what actually causes this business cycle. Again, you look at overall trend, growth trend, but that doesn't mean we don't go through these peaks and valleys through investment. And think about what drives these recoveries is massive investments in things. Okay, well, investments like we just talked about can't always go up. Okay, so at some point they hit their peak and things have to fall off. You don't have to buy new capital. There's not new innovation on the horizon. There could be a change in power, political power, whatever it might be. Okay, that happens over time. So again, investments, not always going to invest, and it's not going to be you're never going to invest. It's just at the right time, are you going to invest more or not? Is that expected rate of return going to be worth the investment? That's the main thing businesses will always look at. Is this going to be worth it? Okay, and that depends on the interest rate and the overall need for the investment.